On September 15, 2008, Lehman Brothers filed for bankruptcy, not decline, not restructuring, bankruptcy. In 48 hours, a 158-year-old financial institution that had survived the Great Depression, 2 world wars, and every major market crash in modern history vanished. $619 billion in assets, gone. But the collapse didn't start on September 15. It started years earlier. And it started with something Lehman itself didn't fully understand. Lehman Brothers wasn't just old, it was legendary. Founded in 1850 by 3 brothers from Alabama, the firm had been at the center of American finance for 158 years. It survived the panic of 1907. It navigated the Great Depression without collapsing. It underwrote America's post-war industrial boom. By the early 2000s, Lehman was one of the big 5 investment banks. Morgan Stanley, Goldman Sachs, Merrill Lynch, Lehman Brothers, and Bear Stearns. These were the firms that moved the market. In 2007, before everything fell apart, Lehman reported record profits of $4 billion. The stock was trading at $80 a share. Richard Fuld, Lehman's CEO, stood at the top of an empire, and the market believed it would be there forever. But dominance had a hidden cost. To compete with Goldman Sachs and Morgan Stanley, Lehman needed to take massive bets. And to take massive bets, the firm needed to leverage itself a lot. By 2007, Lehman's leverage ratio had reached levels that would have been considered reckless just a few years earlier. For every dollar of capital Lehman actually owned, it was controlling $30 to $40 of assets. That's not investing. That's walking a tightrope made of debt. This was the real collapse starting. Not the market failure in 2008, but the structural fragility being built into the firm years before. Because when you're leveraged that heavily, there's no room for error. One bad quarter, one unexpected loss, one market shock, and the entire structure collapses. Lehman knew this. The board knew this. The Federal Reserve knew this. But Lehman was making too much money, so the warnings were ignored. The first crack appeared in late 2006. Then mid-2007, housing prices stopped rising. Subprime mortgages started defaulting. The mortgage-backed securities that Lehman held by the billions began losing value. And unlike a normal investment bank that might have reduced its exposure, Lehman doubled down. The firm bought more mortgage-backed securities, made bigger bets on housing recovery. The internal logic was clear. Housing never falls nationwide. It's never happened. So the losses are temporary. But this time, the logic was wrong. By mid-2007, cracks were spreading. Credit markets began to freeze. But here's what matters. Lehman's public statements didn't change. In July 2008, 3 months before bankruptcy, CEO Richard Fuld told investors the firm had strong liquidity and fortress balance sheet. He was either lying or blind to what was happening inside his own bank, probably both. Because the leverage that looked genius at $80 a share started looking like a death sentence the moment asset values fell. By August 2008, the pressure was unbearable. Lehman had been one of the largest investors in commercial real estate and mortgage bonds. Both were collapsing. Every day, the value of Lehman's assets fell. Every day, the leverage ratio became more dangerous. Creditors started pulling back. The repo market, where Lehman borrowed money overnight to fund its massive bets, began to seize up. Banks stopped trusting Lehman's collateral. This is the moment when years of hidden leverage transformed into existential crisis. The firm that had survived 158 years of market stress was running out of time. By the second week of September, rumors were spreading. Merrill Lynch was in talks with Bank of America. Bear Stearns had already collapsed months earlier. And Lehman was next. The Federal Reserve watched. The Treasury watched. And then they decided, no rescue. Not like Bear Stearns, not like AIG. Lehman would fail. Why? Partly because policymakers believed a bailout would create moral hazard. Partly because Lehman's books were too complicated to unwind quickly. But mostly because by September 15, the decision had already been made before it was technically possible to reverse it. Sunday, September 14, 2008, Lehman Management and the Federal Reserve made one last attempt to save the firm. Bank of America was interested in a merger, but the numbers didn't work. Lehman's assets were worth less than anyone had thought. The losses were deeper. The leverage was more dangerous. Barclays, the British bank, briefly considered taking over parts of Lehman. The talks collapsed by midnight. At 1:45 a.m. on Monday, September 15, 2008, the decision was final. Lehman Brothers would file for bankruptcy, the largest bankruptcy filing in U.S. history. In 48 hours, a firm with $619 billion in assets, 25,000 employees, and 158 years of history was liquidated. The market opened Monday morning. Stock down 95% in minutes, from $80 a share to $3. Assets froze, credit markets seized. The panic spread to AIG, then to money market funds, then globally. One collapse triggered the next. This wasn't just a bank failure. This was the moment the entire financial system understood its own fragility. You might ask, why did Lehman fail when AIG got a $180 billion bailout, when Bear Stearns got rescued, when Morgan Stanley and Goldman Sachs got emergency Fed support? The answer lies in what happened before the crisis. Lehman's leverage had been the highest. Its exposure to housing was the deepest. Its access to the repo market was already cut off. But there's another reason. By the time Lehman failed, the financial system had already recognized it was broken. Bear Stearns had already shown that one collapse leads to contagion. AIG had already shown that insurance derivatives could bring down the entire system. By September 15th, policymakers weren't choosing to let Lehman fail. They were watching a collapse that was already mathematically inevitable. The real decision happened months earlier, when Lehman kept leveraging, when the Fed didn't force deleveraging, when the board didn't acknowledge the fragility. The bankruptcy wasn't a decision. It was an outcome. The collapse of Lehman Brothers wasn't actually about September 15, 2008. That was just the public moment. The real collapse happened in the years before, when leverage became the business model, when risk management became a suggestion, when the warning signals were ignored because the profits were too good. Lehman didn't fail because of the 2008 crisis. The 2008 crisis happened because Lehman and firms like it had spent years building exactly the kind of fragility that turns one market shock into a systemic meltdown. Lehman looked unshakable right up until it wasn't. And that wasn't weakness hiding. That was strength itself. The kind of strength that depends entirely on continued growth, continued confidence, continued access to credit. The moment any of those broke, the entire structure fell. That's the real lesson. Not that Lehman made bad decisions at the end, but that Lehman's dominance was always fragile, and fragility hides best when it's profitable. You've watched Triumphs and Troubles. Subscribe to the channel for true business stories, and comment, which company should we cover next?